investing is one of the most powerful tools you can use to build wealth, yet for many beginners, it feels overwhelming and even intimidating. Stocks, ETFs, index funds. These words may sound complicated, but once you understand the basics, the path becomes much clearer. The truth is that investing is not reserved for the wealthy or financial experts. It is something anyone can learn, and the earlier you start, the stronger the results. A beginner's guide to investing must begin with why investing matters. Saving money in a bank account is important for short-term needs and emergencies, but it will not grow enough to secure your future. Inflation slowly reduces the value of your money over time. Investing allows your money to grow faster than inflation, building wealth and creating financial security. The wealthy understand this well. They do not let money sit idle, they put it to work. So what exactly is investing? At its core, investing means putting your money into assets that have the potential to increase in value or generate income. Instead of trading your time for money forever, you let money work for you. This is the difference between simply earning and truly building wealth. The first type of investment most people hear about is stocks. A stock represents ownership in a company. When you buy a share of a stock, you become a partial owner of that business. If the company grows and earns profits, the value of your shares increases. Some companies also pay dividends, which are regular payments to shareholders. Stocks are powerful because they have historically provided high returns compared to other investments, but they also carry risk. The value of a stock can rise or fall depending on the company's performance in the overall market. Here is an engaging example. Imagine buying one share of a company 20 years ago for $50. If that company grew steadily and its stock price rose to $500, your single share is now worth 10 times more. That growth required no extra work from you. It is money working on money, which is the essence of investing. However, choosing individual stocks can be risky for beginners. It requires research, time, and a willingness to accept volatility. That is why many beginners turn to ETFs, or exchange-traded funds. An ETF is a collection of many stocks or bonds packaged together into one fund. By buying a share of an ETF, you are buying a piece of all the companies inside it. This provides instant diversification, reducing risk. For example, instead of buying one company's stock, you can buy an ETF that holds hundreds of companies across different industries. Index funds are a type of fund similar to ETFs, but with a specific focus. An index fund is designed to track the performance of a market index, such as the S&P 500. The S&P 500 includes 500 of the largest companies in the United States. By investing in an index fund, you are essentially buying a piece of all those companies at once. This is why index funds are often recommended for beginners. They are simple, diversified, and historically produce strong long-term returns. Here is a thought that may interest you. Legendary investor Warren Buffett has said that most people would do best by simply buying an index fund that tracks the S&P 500 and holding it for decades.
Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor.
Even with little knowledge of individual companies, this strategy has beaten most professional investors over time. That is the power of simplicity. Now let us compare these three options clearly. Stocks give you ownership of a single company, which can mean high rewards but also high risks. ETFs give you ownership of a basket of companies or assets, spreading risk across many. Index funds are a special type of ETF or mutual fund that aim to match the performance of the market as a whole. For beginners, ETFs and index funds often provide the safest entry point. One of the most important principles in investing is diversification. Diversification means spreading your money across many different investments so that no single failure can ruin you. Think of it like this. If you put all your eggs in one basket and the basket breaks, you lose everything. But if you spread your eggs across many baskets, one broken basket does not matter much. Diversification protects you from the ups and downs of individual companies or sectors. ETFs and index funds provide diversification automatic, which is why they are powerful tools for beginners. Another key principle is time. Investing works best when you give your money years, even decades to grow. The reason is compound growth. Compound growth means that not only does your original investment earn returns, but those returns also earn returns. Over time, the effect snowballs. For example, $1,000 invested with an average return of 7% per year becomes nearly $8,000 after 30 years without adding any more money. Here is an engaging reminder. You do not need to be rich to start investing. Even small amounts invested consistently can grow into significant sums. A teenager who invests $100 a month until retirement will often end up wealthier than someone who waits until age 30 to start with larger amounts. Time in the market is more powerful than timing the market. So how do you begin? The first step is open a brokerage account. A brokerage account is an account that allows you to buy and sell investments like stocks, ETFs, and index funds. Many online brokerages today make this process simple, with no account minimums and low or zero trading fees. Some popular options include Fidelity, Vanguard, and Charles Schwab in the United States, though every country has its own platforms. Once you have an account, the next decision is choosing what to buy. For beginners, starting with index funds or ETFs is often the smartest choice. For example, an S&P 500 index fund gives you exposure to 500 companies in one purchase. A total market fund gives you exposure to thousands of companies across the entire economy. These funds are low cost, diversified, and proven to perform well over time. Another important factor to consider is fees. Every fund has an expense ratio, which is the percentage charged annually to manage the fund. Even small differences in fees can add up over decades. For example, a fund with a 1% fee may cost you thousands more over time compared to a fund with a 0.05% fee. That is why the wealthy pay attention to costs. Index funds and ETFs usually have very low fees, which is another reason they are recommended. Risk tolerance is another concept you need to understand. Investing always carries risk, but not everyone is comfortable with the same level of ups and downs. Younger investors can usually take more risk because they have time to recover from downturns. Older investors may prefer safer investments. Knowing your risk tolerance helps you decide how much to put in stocks versus bonds or how aggressive or conservative to be. Dollar cost averaging is a practical strategy for beginners. It means investing a fixed amount of money at regular intervals, such as monthly, regardless of whether the market is up or down. This removes the stress of trying to time the market. Over time, it averages out your purchase prices and reduces risk. Consistency is more important than perfection. Here's a helpful mindset shift. Investing is not gambling. Gambling is based on luck, but investing is based on ownership of assets that produce value. Companies create products that provide services and earn profits. By investing, you share in those profits. The market may go up and down in the short term, but over the long term, it reflects growth in real businesses. That is why patience and consistency matter more than reacting to every swing. It is also important to avoid emotional decisions. When markets fall, fear drives many people to sell, locking in losses. When markets rise, greed drives people to chase hot stocks, often buying too late. The wealthy do not let emotions control them. They focus on long-term strategy, not short-term noise. As a beginner, remind yourself that downturns are normal and temporary. Staying invested is how you benefit when the market recovers. Retirement accounts are another tool that beginners should use. Accounts like 401(k) IRAs or Roth IRAs in the United States provide tax advantages that boost your investments. Some reduce your taxable income now, while others allow tax-free withdrawals later. Using these accounts is one of the most efficient ways to invest. Even small contributions grow dramatically over decades thanks to both compounding and tax benefits. Here's another engaging example. Imagine two people who each invest $200 a month. One uses a taxable account, the other uses a Roth IRA with tax-free growth. After 30 years, both accounts grow significantly, but the Roth investor keeps all the gains without paying taxes on withdrawals. That difference can mean tens of thousands more in their pocket. Another area to explore is dividend investing. Some companies share their profits by paying dividends to shareholders regularly. By reinvesting those dividends, you can accelerate compounding. Over time, dividend income can grow large enough to cover expenses, creating financial independence. Many wealthy individuals focus on building portfolios of dividend-paying companies and funds. Bonds are another investment option, though often less exciting than stocks. Bonds are essentially loans you give to governments or companies. They pay you interest in return. Bonds are considered safer than stocks, but usually provide lower returns. A balanced portfolio often includes both stocks and bonds to match your risk tolerance and goals. Real estate investment, trusts, or REITs are another way beginners can diversify. REITs are companies that own income-producing properties like apartments, shopping centers, or offices. By buying shares of a REIT, you gain exposure to real estate without directly owning property. REITs also pay dividends, making them attractive for income-focused investors. As you grow in confidence, you may explore more advanced strategies, but the foundation remains the same: diversify, stay consistent, and let time work for you. Beginners often get distracted by day trading or chasing quick profits, but this usually ends in losses. True wealth comes from steady, disciplined investing. Here is a reminder. The stock market has gone through wars, recessions, crises, and yet over time, it has always risen. Why? Because businesses keep growing, innovating, and serving people. Investing is not about predicting the next week or month. It is about trusting in long-term progress. The beginner's guide to investing comes down to a few simple truths. Start early, even with small amounts. Use index funds and ETFs for diversification and low fees. Reinvest your earnings to harness compounding. Stay consistent with contributions. Avoid emotional decisions, and let time work for you. Investing is not reserved for the wealthy. It is how everyday people become wealthy. If you found this guide valuable and want more beginner-friendly strategies for growing your money, join us here at Level Up Wealth. Subscribe so you never miss practical insights that can transform your financial future. Remember, your journey to wealth begins not tomorrow, but today with the first step you take. Let your money work for you and watch how even small investments grow into something powerful over time.